Hello, welcome back to Financial Management. So, thus far, we have added market frictions into capital structure, and we've shown that when you have market frictions like taxes, the capital structure matters. How we divvy up the firm between debt and equity of X firm value. Why? Well, we found that interest payments are tax deductible. We know dividend payments are not. And we found how you can increase the present value of the firm by taking the present value of these tax shields. And we also applied the WACC to taxes, and we showed that, yeah, actually we can have a higher firm valuation using an after WACC, a WACC after taxes, because we're having a smaller discount rate. This lesson, we're going to focus on bankruptcy costs and information asymmetries. And the main idea is that we'll see how these frictions of bankruptcy costs and incomplete information can actually make the way that we finance the firm affect firm value. So the way that we'll think about these bankruptcy costs affecting firm value is going to be through the free cash flow of the firm. And sort of the intuitive point is that if there's going to be something that's costly, that money is not going to go to bondholders or to shareholders. That money is going to go outside. So because there's going to be a reduction in that free cash flow, then it's going to reduce the value of the firm. So let's go through taxes and leverage. Last lesson, we learned that financing with more debt raises the firm value because of the tax shield from debt. We said the value of the firm, the levered firm, equal the value of the unlevered firm, plus the tax rate multiplied by the face value of debt, assuming that the debt is perpetual. So if debt is so awesome, why aren't most firms highly levered? Well, the answer is going to be because debt has its drawbacks. Debt is going to have bankruptcy, which can be a costly process, which we'll go into detail next. And debt also can reduce financial flexibility. In a survey of CFOs about 15 years ago, 70–80% of the respondents said that the number one thing that's affecting how they decide to finance the firm is financial flexibility. Basically, wanting to be able to save some debt capacity to issue funds if you have an investment opportunity or if you really need to. You want some financial slack. So, what are bankruptcies? Well, a firm would want to avoid high leverage because bankruptcy can be costly. And this is also known as the cost of financial distress. Having more debt increases the probability that the firm will go bankrupt. Bankruptcy itself is not a market friction. We think bankruptcy is perfectly fine. The firm isn't able to continue to be a profitable, viable entity. It's going to take those assets and then give them to another firm. That's wonderful. The issue are the costs associated with bankruptcy. Because these costs are not going to go to bondholders or shareholders, they're going to somebody that's not an investor, we can think of it as distortive. It's going to reduce firm value. So let's take into account those costs. We've got the value of the levered firm equal the value of the unlevered firm plus the present value of tax shields minus the present value of the expected bankruptcy costs. Okay, what is bankruptcy? A firm that can't make its payments to debt holders is said to go into default. Debt holders then have the legal right to collect what is owed by seizing the firm's assets. So if the firm does go into default, it can go into two types of default. Chapter 7, in which the firm's liquidated. So this is a liquidation. We sell off all the assets and we use the money to pay back debt holders. And then Chapter 11, which is much more common. This is a reorg. If the firm is going through a reorganization, the debt repayments are suspended, and then the managers are going to propose a plan to the debt holders. If the debt holders approve, then the firm is able to continue and it's basically reorganized. Okay. There are direct costs to bankruptcy, and these are going to include legal fees, paying for your accounting, your consulting, your appraisers. If you do have a reorg and you do need to issue some new securities, then of course your investment bankers are going to be charging fees. So these are the sort of direct costs, and the direct costs can be quite high. United Airlines in 2001 had to enter into a reorg. So in 9/11, two of the planes that crashed were owned by United. During quarter four 2001, we also had a market-wide downturn. Oil prices went through the roof. People were afraid to fly. All of that spells bad news for United Airlines. So what happened? Well, United needed to raise more capital so it could continue to cover its operations and cover its debt payments. But unfortunately, equity and bondholders were not interested in supplying the firm with fresh capital. So in December of 2002, a year after, United Airlines had to enter Chapter 11. This reorganization cost an average of 8.6 million per month for legal and professional services and lasted from 2003 to 2005. So the point is that these direct costs of bankruptcy can be quite high. Enron, this was, to its point, the largest bankruptcy in US history. So this is a quote from Jeffrey Skilling, the former CEO of Enron in 2001. I've never not been successful in business or work ever. Obviously, I wouldn't be telling you about this case unless things took a turn. So a few months later, Enron would actually file for Chapter 11. Enron was one of the world's largest and most successful energy and natural gas companies. However, management got in the habit of using these special purpose off the book entities. Think of it as I have a project that's unprofitable, or I have a trading strategy that's done terrible. Rather than take that hit of revenue on my actual books, I'm going to create an offshore entity and put the losses over there. So this is a good way to cook the books until people find out that you've been a fraud the whole time. And so the firm filed for Chapter 11 in 2001. And this process was incredibly costly. This Chapter 11 reorg took about 3 years and 750 million in legal and accounting fees. Eventually, all of the subs were sold off. Arthur Andersen, the original auditor of Enron, eventually went bankrupt. And in response to all of this, we had the Sarbanes-Oxley Act of 2002, SOX. And this was introduced to curb some of the fraudulent accounting practices that led to the Enron episode. The last real world example is going to be Lehman Brothers. So until October in 2008, that Enron bankruptcy was the most expensive in US history in terms of legal fees. Lehman Brothers began its bankruptcy process again in October of 2008. This bankruptcy process has been ongoing. 5 years into Lehman Brothers bankruptcy, so as of August 2013, Lehman had paid more than 2.2 billion to its lawyers, accountants, consultants, and other professionals to assist in the wind down of the investment bank. By 2019 and still today, this bankruptcy has gone up to 7 billion in terms of, again, legal fees, consultants, accountants, all of it, to carve up the firm's assets. The point of these examples is that all of this money that's being spent on these legal fees, accountants, consultants, etc., that's not cash that is going into an investor's hand. So that's going to reduce firm value. We also have indirect bankruptcy costs. So the loss of customers, less likely to buy a product without future support. The loss of suppliers who are afraid that they're not going to get paid back. Employees. Your employees have human capital that's tied up in the firm. Their focus, attention, and energy is going to be on finding another job and not on working for a company that's continuing to go under. And these indirect costs aren't only limited to employees. We have loss of receivables. So if I'm a major customer, I'm going to be much less likely to repay my debt if the firm is financially distressed, because why would I do it? They're going to go under anyway. We have the fire sale of assets. If I need to sell something, if I need to sell an asset in order to raise cash, I might have to sell it at even lower prices than I would want to. So it's going to make me even less profitable as I try to get this cash to deal with this period. And then also intangible assets. Some of the value of a firm is going to be hard to convert into cash. And you can think of this as like goodwill, or sometimes the value of a brand. So these can be quite costly. The combined bankruptcy costs are estimated to be 10 to 30% of pre-bankruptcy value of the firm. The direct costs have been estimated to be around 2 to 10%, and the indirect costs have been estimated to be around 10 to 20% of the pre-bankruptcy market value of total assets. The punchline is that this can be a costly process. And obviously we want to know who pays for these costs. Well, this sort of happens in two ways. First, the expected bankruptcy cost is going to decrease the value of the firm. And if I'm a bondholder and I know that if the firm becomes financially distressed, that they're not going to be able to pay me back, what I'm going to require is a higher promised return in order to compensate me for the expectation that if things go bad, the firm won't be able to pay me back. So we'll do a few examples to show how that works. Ultimately, if we have to pay more to bondholders in order to compensate them for this risk, then we get less to equity holders. So the answer is it's going to be equity holders. Equity holders ultimately end up paying for these expected bankruptcy costs. So let's look at some bankruptcy equations. We can take our CAPM and we can apply the risk-free rate plus the beta of the debt multiplied by the market risk premium. If the debt is maturing in 1 year, we can find the expected return on debt as the expected cash flow divided by the price minus 1. And obviously, if we're looking at our expected cash flow, we're going to have two states. So we're going to have a good state in which there's a promised cash flow. You can think of this as if the firm is able to pay, this is what they're promising to pay. And then we're also going to have a bad state with the bankruptcy cash flow. And obviously that cash flow is going to be lower. Now, before we moved on to the promised yield, let's just take a second and look at that expected cash flow equation. If I'm a bondholder and I know that the bankruptcy cash flow is going to be low, then I'm going to require that the promised cash flow be higher in order to keep my expected cash flow the same. Meaning, if I know that if the firm goes bankrupt, they're going to have less cash to pay me, then for the promised cash flow, you're going to have to pay me a lot more to make me comfortable lending to you in the first place. Promised yield, the promised yield, we have our promised cash flow divided by the price minus 1. And again, it's the promised cash flow. So this is the cash flow that I'm promising you in the good state divided by the price minus 1. Let's do an example. So you're an entrepreneur who's considering a 10 million investment into a short-lived project. The project is going to last for 1 year. It will produce cash flows of either 8 million or 25 million next year with equal probability. The cash flows are unrelated to the state of the economy, so there's no systematic risk. Great, so we know beta is going to be 0, makes it very easy to plug away as we try to find our expected returns. We're going to assume a risk-free rate of 5%. Okay, so the project, if it's good, 25 million, bad, 8 million, cost 10 million to invest in, short-lived for 1 year, and we know that our expected return on everything is going to be 5% because the beta is 0. Suppose you invest in this project by raising 10 million in equity markets. What is the value of your firm's assets? As we set this up, we're going to have our expected cash flow. So that's going to be half the time 8 million, half the time 25 million. That, so 0.5 times 8 and 0.5 times 25 divided by 1 plus R. And our R is going to be 5%. How did we get that? Again, beta of 0. So 0.58 times 0.5 times 8 million plus 0.5 times 25 million divided by 1.05. Okay, part B. What's going to be the expected return on debt? The expected return on debt is going to be 0.05. Why? Because beta equals 0. So there's no systematic risk. Very straightforward. Part C. What will be the promised cash flow to debt holders such that they get the expected return in part B? So how are we going to set this up? We're going to set this up in 2 ways. First, on our left-hand side, we've got the expected return for debt. We actually know what this number is. So that's going to be 0.05. Now, on our right-hand side, we're going to have to put an equation. What are we going to do? What we want to do is solve for the promised cash flow. So how do we set that up? In our numerator, we've got 0.5 multiplied by the promised cash flow plus 0.5 multiplied by 8 million, all of that divided by 10 million, and that whole number minus 1. What we'll see as we solve down for this is that the promised cash flow is going to be adjusted. It's going to be the thing that we change in order to solve for the given expected return. So as we set this up and solve through, hopefully you'll find that the promised cash flow will be 13 million. Your promised yield, what's going to be the promised yield? Very straightforward. We're going to take our promised cash flow minus the 10 million. This is what the project was financed for using debt, and then that divided by 10 million. Okay, a few more. Let's fill in the following table. So we've got the cash flow to assets, debt and equity for the bad state, the good state, and then on average, what do we expect? In the bad state, the cash flow to assets is going to be 8 million, debt is going to get 8 million, and equity is going to get nothing. In the good state, the cash flow to equity is going to be 25 million. We have to promise debt holders a cash flow of 13 million, so that's going to be 13. And then equity holders are going to get the 12 million left over. And if we average across those states, we'll find that the cash flow to assets on average is going to be 16.5 million. To debt, it's going to be 10.5 million. And to equity, it's going to be 6 million. Fairly straightforward. What is the expected return on equity and the value of equity? The expected return on equity is still going to be 0.05 because, again, the firm has a beta of 0. Therefore, the value of equity is going to be the present value of the expected cash flow to equity, which is 6 million divided by 1.05. If we want to find the value of the levered firm, we take the value of the debt, that's 10 million, plus the present value of equity, that's the 5.71, and we find that it's 15.71 million. So that shouldn't come as a shocker. What we observe is that the value of the unlevered firm in this example is going to be really, really close to the value of the levered firm in this example. Okay. So what are we, there's just one thing I want to point out is that, again, in this example, we've got everything without bankruptcy costs. So what happens, example 2? What happens if the firm has to pay a legal fee of 2 million? Well, for part A, again, we're going to repeat the same steps. We've got the value of the unlevered firm. It's still going to be the expected cash flow of 8 million and 25 million averaged divided by 1.05. So that's still going to be the same. Why? Because if the firm is all equity, then there is no default. So it doesn't matter that there's some legal fee, it's not going to ever actually face it. The expected return on debt, part B, that's going to be the exact same. Part C, the promised cash flow. As you set this up, you're going to repeat the same steps you did before. So you've got 0.05 on the left-hand side equal to 0.5 multiplied by the promised cash flow plus 0.5 multiplied by 8 million minus 2 million divided by 10 million, all of that minus 1. And what do you notice when you set this up? When you set this up, 2 things should jump out. First, you'll see how because the firm is going to face this legal fee, the expected cash flow that I'm going to get in the bad state of the world is going to be lower. So I have to offer an even higher promised cash flow. So you'll observe that the promised cash flow in example 2 is actually going to be higher than the promised cash flow in example 1. And the difference is actually going to be those legal fees. Okay, so a few more steps. We want to solve for the promised yield. Again, straightforward, we know how to do that. You'll notice that the promised yield is higher in example 2 than in example 1. And then when you set up the cash flow table, so again, you'll notice that the expected cash flow is now reduced for every type of cash flow. So the expected cash flow to assets is going to be lower, the expected cash flow to debt is going to be lower, and the expected cash flow to equity is also going to be lower. Okay, for parts F and G, the expected return for the equity is still the same, but the difference now is that the value of equity, it's going to be lower. So if we solve everything out and find the expected cash flow to equity, we'll find that in example 2, the expected cash flow to equity will be 5 million. So the present value of that 5 million is going to be 4.76 million. As we look at the value of the levered firm for part G, that debt plus equity is going to be lower than the debt and equity sum that we had in part A. that the value of the unlevered firm that we solved for in part A. So what is the loss in value? The loss in value due to these legal fees is going to be the present value of those expected legal fees. So the present value of the expected legal fees. What does that mean? It means that the firm's value is going to fall by not 2 million, but 0.5 multiplied by 2 million, because half the time the firm is going to face bankruptcy, and then the present value of that 1 million. So that 1 million divided by 1.05. Okay, so what are the two things that hopefully we gather from observing these examples? We can see in the previous example that in the presence of bankruptcy costs, the value of the levered firm is lower than the value of the unlevered firm. The difference accrues to the value of firm's equity. So because of this, the value of equity is going to be reduced. That is, equity decreases by the present value of the expected costs of financial distress. Some of the difference in firm value between examples 1 and 2 is the same as the present value of the expected loss due to financial distress. So when we look at the difference is the present value of those expected legal fees. That's what we think of as the expected loss due to financial distress. Okay, there's also going to be conflicts of interest between bondholders and stockholders. Bondholders are going to prefer that the firm sticks to something that's safe, that's going to have very guaranteed cash flows, and stockholders are going to prefer something riskier that has a higher expected payoff if things go well, but could also have a higher default and be more harmful to bondholders if things go poorly. If managers are going to be maximizing shareholder value, then they're more likely to take on these riskier projects, which is going to increase the likelihood of bankruptcy. Let's do an example. Suppose that a firm owes 20 million to debt holders next year and currently has 20 million in cash. The firm can invest in one of two projects today. Each costs 20 million and has the same discount rate. Project A is going to produce a single cash flow of 21 million or 22 million next year with equal probability, or Project B, which is going to produce a cash flow of 8 million or 35 million, again with equal probability. If it goes bankrupt, the firm is going to incur a bankruptcy cost of 5 million. The object of managers, the objective, is going to be to maximize shareholder value. Okay, so let's go through. What is the expected cash flow from each project? Very straightforward. When you set it up and solve for your expected cash flow, what you'll notice is that the expected cash flow for both projects is the same. Part B, what is the expected cash flow to bondholders for each project? For Project A, the expected cash flow to bondholders is still going to be 20 million. Why? Because under all scenarios, you're going to have enough to pay back bondholders. For Project B, half the time, there's going to be 8 million in cash flow minus the cost of bankruptcy, so minus the 5 million, and then half the time you're going to be able to pay back the 20 million. For Part C, what is the expected cash flow to stockholders? Again, it's just going to be the residual, or what's left over from the asset cash flow minus the debt cash flow. So as you solve Part C, what you'll notice is that the expected cash flow to equity holders for Project B is way higher than the expected cash flow to equity holders for Project A, even though Project B has a state of the world where equity gets nothing. Okay, what is the total expected cash flow to all investors for each project? So the correct way to set this up is to do sort of in two steps. First, for Project A, we'll have 0.5 multiplied by the sum of what goes to bondholders, and that's going to be 20 million, plus the 1 million that goes to equity holders. And then 0.5 multiplied by, again, the 20 million that goes to bondholders if the project goes well, and then the 2 million that's left over to go to equity holders. You take those averages and we'll find that the average to investors for Project A, the expected cash flow is going to be 21.5 million. For Project B, same scenario, same setup, and what we'll notice is that for Project B, the expected cash flow to investors is actually going to be smaller. So as we solve for it, you'll see very clearly that it's going to have a smaller expected cash flow. Which project would managers choose? Obviously, managers would choose project B. Even though it has a smaller expected cash flow to all investors, it has a higher expected cash flow to shareholders. So this is how we can think of this conflict of interest. If we think back to example 2, we see that when there are bankruptcy costs, bondholders demand a higher promised return on debt. So because there's less cash left over for stockholders, the value of the firm is going to decrease as leverage increases. So it's going to fall because of this expected cost of financial distress that's going to fall onto stockholders. And again, the mechanism is that stockholders have to pay a higher promised cash flow to bondholders given the expected cost of financial distress. Okay, so remember from our last lesson that we said that there was a interest tax shield. And now we're saying that there's bankruptcy costs. We've got a plus and we've got a minus. There must be some way to find an optimal or the best capital structure, the best mix of debt and equity, given these two things that the firm is trading off. So let's set up an example and see if we can find the capital structure that's going to maximize the net present value of financing. We're trying to find the capital structure that's going to make the present value, the net present value of financing the highest. How do we do that? Well, we're going to be solving for the trade-off between the cost and benefits of leverage. This is an application of a theory called the trade-off theory. And the trade-off theory says that firms are trading off the financial distress with the tax benefit of debt. Okay, so what do we have? We've got all of these different debt levels. So the firm could have a debt level of 0 all the way up to 35. And then for each debt level, we've got the present value of a tax shield and the present value of a bankruptcy cost. How are we going to set this up? What we want to find is the level of debt that has the highest net benefit or the highest NPV of financing. What do? Let's subtract the benefit, the present value of the tax shield, from the costs, the present value of those bankruptcy costs. And as we do it, and as we go through and subtract one from the other, hopefully what we'll observe is that there is a level of debt that actually has the highest net benefit. So hopefully you'll find that that's going to be at 20 million. Okay, so in conclusion, why don't firms use more leverage? Well, bankruptcy is costly. As we discussed before, the combined direct and indirect cost of bankruptcy can be about 10 to 30% of the pre-bankruptcy value of the firm. Therefore, if I'm a firm, I may prefer to avoid high leverage given the risk of facing these really high direct and indirect costs. The other reason why firms may use less leverage is financial flexibility. And there are other reasons too, but the big one is financial flexibility. Maintaining excess debt capacity just in case you'll need room for emergency funding or to fund an investment opportunity is incredibly important. So what have you done thus far? Thus far, you've been able to show how capital structure matters when we have a market friction. The first was taxes, and now we've done bankruptcy. What we'll do next is going to be incomplete information and signaling.